The economic relationship between India and the United States stands as one of the most significant bilateral partnerships of the 21st century. It's a testament to shared democratic values and increasingly intertwined commercial interests. In recent years, this partnership has flourished, with total trade routinely surpassing $150 billion, and at times approaching $200 billion annually. That sum is not just a number, it represents a vast network of exchange. Factory floors in Gujarat, tech campuses in Silicon Valley, American farmers sending goods to Indian consumers. It's the lifeblood of countless businesses and the foundation of millions of jobs across both nations. Yet beneath these headline numbers, tension began to swell in the late 2010s. Subtle policy shifts and sharper rhetoric slowly escalated into a public standoff. The United States, under an America First approach, re-evaluated trade ties, while India, focused on domestic priorities, adopted protectionist measures. The friction came from many grievances across multiple sectors, turning mutual growth into strategic competition and retaliation. We'll dissect this conflict, moving beyond figures to causes and consequences. Look at specific policies, tariffs on steel, regulations on data, and the ripples they caused. This is a story of two economic giants, each protecting their interests in an uncertain global landscape. It's not just dollars and cents, but a clash over rules of global commerce and the state's role. Understanding this standoff is key. It's a microcosm of broader global trends. The India-USA relationship is more than bilateral. It's a barometer for the global trading system. How these democracies handle their differences will signal the future of international cooperation, strategic partnership, and open markets. The genesis of the India-USA trade standoff cannot be attributed to a single event, but rather to a gradual accumulation of policy shifts and divergent economic philosophies. The primary catalyst was the strategic pivot in American trade policy that began around 2018. The U.S. administration at the time initiated a broad review of its trade agreements, arguing that many partners were leveraging unfair advantages to the detriment of American workers and industries. This led to the imposition of sweeping global tariffs, most notably a 25% tariff on steel and a 10% tariff on aluminum under Section 232 of the Trade Expansion Act. While these were not aimed exclusively at India, they inevitably ensnared Indian exporters who saw their products become significantly more expensive in the American market overnight. In response to these unilateral American actions, India did not remain passive. Invoking its rights under World Trade Organization rules, New Delhi prepared and eventually implemented a set of retaliatory tariffs. These were carefully calibrated to target specific American goods, thereby applying political and economic pressure on the United States. India raised duties on approximately 100 U.S. products, including high-profile agricultural goods like almonds, walnuts, and apples, as well as certain chemicals and metal products. This countermove was designed not only to compensate for the economic losses from the U.S. tariffs, but also to signal that India would not be a silent bystander in this new era of assertive trade diplomacy. Beyond the headline-grabbing tariff wars, deeper, more systemic issues were also at play, particularly concerning market access and regulatory frameworks. The U.S. had long-standing complaints about India's trade practices, which it viewed as protectionist. The core of the trade dispute manifested through a detailed and strategic deployment of tariffs, affecting a wide array of goods and services that form the backbone of the bilateral economic exchange. The most prominent goods flowing from India to the United States include pharmaceuticals, particularly generic drugs, valued at around 12 to 15 billion annually. Diamonds and precious gems, textiles and apparel, software and IT services. When the U.S. imposed its steel and aluminum tariffs, it directly impacted Indian metal exporters. More critically, the revocation of GSP status hit key sectors: textiles, leather goods, engineering products. Conversely, the United States exports a range of high-value goods and critical commodities to India. The list is topped by mineral fuels, including a significant increase in crude oil shipments in recent years, and liquefied natural gas shipments, precious stones, machinery, aircraft and their components, optical and medical instruments. American agricultural products, especially tree nuts like almonds and walnuts, and fruits like apples, had also carved out a substantial market in India. It was these very agricultural goods that became the primary targets of India's retaliatory tariffs, with duties on some items increasing by as much as 20%, directly impacting American farmers who relied on the vast Indian consumer market for their livelihoods. The conflict, however, extends far beyond tangible goods into the increasingly vital domain of services and digital trade. India's prowess as an IT and business process outsourcing hub means it runs a massive trade surplus in services with the US, exporting tens of billions of dollars worth of software development, back-office support, and call center services each year. While direct tariffs are not applied to these services, the US has used other policy levers, such as tightening the rules and raising the costs for H-1B visas and other work visas. The India-US trade standoff is often framed in terms of billions of dollars and percentage points, but its true impact reverberates through the lives of workers, through the decisions of investors, and through the stability of global supply chains. One of the most significant, though less visible aspects, is the flow of foreign direct investment, American companies have been among the largest investors in India. Technology, e-commerce, manufacturing, financial services. This capital is not just an entry on a ledger, it translates into tangible projects, factories, research centers, offices, creating hundreds of thousands of well-paying jobs and fostering critical skill development. When trade tensions escalate, this vital flow of investment becomes fraught with uncertainty. Corporations, which prize stability and predictability, become hesitant to commit to large, long-term capital expenditures. A US tech firm planning a new data center in India might pause its plans amidst ambiguity over data localization laws. Similarly, a manufacturer looking to build a new plant might delay its decision, fearing tariffs or retaliatory duties. This chilling effect on FDI can slow down economic growth, it can stifle innovation, and limit the creation of new jobs, impacting the economic aspirations of millions in India. The human cost is also felt acutely in specific communities on both sides of the Pacific. In the United States, farmers in California's Central Valley faced an immediate drop in demand and prices when India's retaliatory tariffs took effect. For these agricultural communities, the impact was direct and personal, threatening family farms and local economies. Likewise, small and medium-sized enterprises in Indian industrial towns found their profit margins squeezed. Ludhiana, Tirupur. Many saw orders cancelled after losing duty-free access under the GSP program, placing thousands of jobs at risk. The trajectory of the India-US trade standoff can be understood by examining two distinct periods. Each period had different actions and reactions. The first timeline, 2018 to 2019. It was a phase of rapid escalation and direct confrontation. It began in March 2018. The US imposed a 25% tariff on steel. It also imposed a 10% tariff on aluminum. These tariffs targeted a wide range of countries, including India. New Delhi responded after deliberation by announcing retaliatory tariffs. That tit-for-tat exchange set the tone, shifting away from quiet negotiation toward public punitive measures. In June 2019, the US revoked India's GSP benefits. That removed duty-free status for nearly $6 billion worth of Indian exports. Thousands of products and businesses were impacted. Days later, India implemented retaliatory tariffs on 28 American products. By the end of 2019, both sides were in talks, but negotiations produced very limited results. The relationship entered a tense stalemate and trade volumes dipped amid uncertainty. The second timeline, 2020 to 2023. This was a phase of disruption. It was also a period of reevaluation, and it involved strategic adaptation. The phase was heavily influenced by the COVID-19 pandemic. The global health crisis in 2020 was a massive external shock, disrupting supply chains and causing a sharp temporary drop in global trade. As the world emerged from the initial shock, the story shifted from confrontation to strategic realignment. The trade standoff between India and the United States is not an unsolvable puzzle. The path to de-escalation needs political will and pragmatism. Option 1. Negotiate a mini-trade deal or bilateral trade agreement. Set clear, quantifiable goals. Both sides make concrete concessions. US. Reinstate India's GSP benefits. US. Lower tariffs on selected goods. India. Cut high tariffs on motorcycles. India. Cut high tariffs on certain agricultural goods. India. Strengthen intellectual property protections. This is holistic but needs political capital. Option 2. Selective cooperation sector by sector. Prioritize mutual benefit areas. Fast-track a pharmaceuticals pact. Collaborate on semiconductor manufacturing. Create joint standards for clean energy technology. Incremental wins build trust and momentum. Option 3. A partial pause or tariff truce. Freeze current tariff structure. No new punitive measures for a set period, 1 to 2 years. That adds stability and predictability. Businesses can plan without fear of new duties. It restores investor confidence. It gives officials space for deeper negotiations, away from retaliatory cycles. Ultimately, the India-US relationship is too valuable for perpetual conflict. Total trade is nearly $200 billion. It supports jobs, it fosters innovation. It gives consumers more goods and services. The goal: a strong, prosperous, fair and equitable trade partnership for the century ahead.